In the last session, we briefly looked at theories that help us estimate the price and risks associated with equity stocks and equity portfolios. The return Ri or Rp, the risks associated with that portfolio or the stock, beta P or beta I, market returns Rm, risk-free rate Rf, standard deviation sigma, etc. With that understanding and recap, let's look at the most commonly used techniques to evaluate the performance of portfolios of equity stocks such as mutual funds. So what you have on the screen now is a recap of the two formula that we looked at, beta P equal to covariance Rm Rp divided by the variance Rm, and the expected return on the portfolio ERP is equal to Rf plus beta P into Rm minus Rf. Now in these cells we have 4 portfolios, 1, 2, 3, 4. The sigma of each of these portfolios over a 3-year cumulative data is sigma P. For portfolio 1 it's 0.12, portfolio 2 0.15, portfolio 3 0.10 and portfolio 4 0.18. In the same way, the 3-year cumulative beta for these 4 portfolios is 0.76, 1.02, 0.75, 1.16. As you can see, there are 2 of them which are significantly more risky than the ones with beta of 0.75 and 0.76. The market return, that is the return in the market where these portfolios are being traded, is 12.20, and the corresponding risk-free rate is 8%, which is constant across the 4 portfolios. Now, using this formula, expected return on a portfolio, we have calculated the expected return for the 4 portfolios, which is portfolio 1 11.19, portfolio 2 12.28, portfolio 3 11.15 and portfolio 4 12.87. Now this is the expected return which is computed based on the capital asset pricing model formula. What is the actual returns delivered by these 4 portfolios on the ground? What is it that they delivered? The actual returns is 12.32 for the first portfolio, 17.38 for the second portfolio, 12.28 for the third portfolio, 12.32 for the last, the 4th portfolio. You have a challenge now. Let's say you have 1,000,000 currency units to invest and you have decided that you wouldn't go and invest them in all the 4, you would rather invest them in 2 out of these 4 portfolios. Your challenge is which of these 4 would you select to invest in? So with that data we just saw in the spreadsheet, let's examine the 3 commonly used methods to assess risk-adjusted returns on the 4 equity portfolios using 3 methods: Jensen's alpha, Sharpe ratio and Treynor ratio. It will help you make a relative evaluation and decide which are the 2 portfolios that you should invest in on a risk-adjusted basis. First measure, and may I say my favorite measure, is Jensen's alpha. Expressed mathematically, Jensen's alpha, alpha P, is equal to Rp, which is the actual return on a portfolio, minus the expected return on that portfolio, which is given by the capital asset pricing model formula Rf plus beta P into Rm minus Rf. While this formula could look a bit confounding at first sight, if you examine it carefully, it reflects the actual return Rp from the portfolio less the expected return from that portfolio computed using the capital asset pricing model. Therefore, higher the alpha P, better the performance of the portfolio, because the actual returns that it delivered was greater or far greater than the expected return on that portfolio. For an illustration of how this ratio is used, let's go back to the same spreadsheet. So this is what we saw in the last screen. These were the actual returns delivered. Now the expected return is in this column, and therefore Jensen's alpha is nothing but the actual return minus the expected return, and therefore the figures you get for the first portfolio 1.13, the second portfolio 5.10, the third portfolio 1.13, and the fourth portfolio minus 0.55. Now it's a no-brainer. Out of the 4, you would obviously want to not invest in portfolio 4, because it's giving you a Jensen's alpha which is negative. In other words, it gave an actual return of 12.32 when the expected return was 12.87. In other words, this portfolio gave you an actual return which is less than the expected return. So you're not even going to look at investing in that portfolio. Now let's shift our focus to the other 3. Now this one looks exciting because it's got the highest Jensen's alpha, 5.10. So you might be tempted to say, I should invest in this portfolio too. Now here's a word of caution. The actual return of 17.38 is far greater than the expected return 12.28. Question is this return by this portfolio sustainable in the years ahead or going forward? The second question is, if you compare the sigma of these portfolios, portfolio 2 has a far higher standard deviation than portfolio 3 and portfolio 4. Remember, we have eliminated portfolio 4, which is the highest standard deviation or the highest level of risk. Portfolio 2, 0.15, is the next highest level of risk. Interestingly, it also gave you the highest Jensen's alpha. So you could go ahead and invest in this, provided you're willing to absorb the fact that portfolio 2 comes to you at a much higher level of risk at 0.15, and that this high returns and a high Jensen's alpha of 5.10 is sustainable in the years ahead. If you're willing to take that risk, go ahead and select that portfolio. The real challenge is, how do you choose between portfolio 3 and portfolio 1? Both give a Jensen's alpha of 1.13. In other words, the actual return on portfolio 1 is 12.32, portfolio 3 is 12.28, and it's consistent with the difference in the expected return, 11.19 and 11.15. So you got a problem here. Which one do you choose? Remember, we had decided upfront our investment strategy is going to be investing in 2 out of the 4 portfolios, depending on whichever gives you the highest return on a risk-adjusted basis. We will go ahead with portfolio 2 because it's got the highest Jensen's alpha, although it's got a higher standard deviation or volatility as well. The challenge now is to choose between portfolio 3 and portfolio 1. To do that, we got to resort to some other measures, which leads us to the next measure called Sharpe ratio. Sharpe ratio look at the performance of the portfolio adjusted for the risk of the portfolio measured by its standard deviation vis-a-vis the return on a risk-free asset such as government securities. Mathematically, it would be Rp minus Rf divided by sigma p, where, as you will recall, Rp is the return on the portfolio, Rf is the return on a risk-free asset, sigma p is the standard deviation of that portfolio, as we learnt in an earlier session, which measures the volatility and hence the risk of the portfolio. The relative performance of different portfolios of equity stocks in our case portfolio 1, 2, 3, 4 can be evaluated using the Sharpe ratio. Higher the Sharpe ratio, better the expected performance of that portfolio. Let's go back to the same spreadsheet to see how Sharpe ratio can be used. So what we see in this spreadsheet is just one extra column, which is the Sharpe ratio. And remember, the Sharpe ratio is to be calculated as the actual return on the portfolio minus the risk-free rate divided by the standard deviation of the portfolio. Now the actual returns are given in this column, the risk-free return is given in this column, and the cumulative 3-year cumulative standard deviation is given in this column. So there is fairly straightforward. And you get this very interesting observation. Remember, our challenge was to select between this and this. Expectedly, for portfolio 2, the Sharpe ratio is the highest because RP is 17.38%. Now in the numerator, RP is 17.38%, RF is constant for all 4 portfolios at 8%, and sigma P is marginally higher at 0.15. Be that as it may, because of the high numerator, portfolio 2 gets a very high Sharpe ratio of 0.62. The challenge, as we recall, is to choose between portfolio 1 and portfolio 3. Now portfolio 1 gives you a Sharpe ratio of 0.35 and portfolio 3 gives you a Sharpe ratio of 0.43. Now we just learned higher the Sharpe ratio, better is the risk adjusted return for that portfolio. Why is portfolio 3 at 0.43 higher than 0.35 of portfolio 1? Pretty simple. Portfolio 1 has a sigma P of 0.12, whereas portfolio 3 has a sigma of 0.10, which is lower. And so since sigma P comes in the denominator of the Sharpe ratio computation, the numerator is constant for both of them. Remember, it's 0.13 and 0.13, whereas the sigma P for portfolio 1 is higher than it is for portfolio 3, and therefore portfolio 3 gets a Sharpe ratio which is higher because the denominator is smaller and it gets a Sharpe ratio of 0.43, whereas this one gets 0.35. So whereas based on Jensen's alpha, we were in a dilemma whether to choose portfolio 1 or portfolio 3, Sharpe ratio has helped you confirm that you're better off going with portfolio 3 than portfolio 1 because it has a higher Sharpe ratio. So that's how you use Sharpe ratio to decide which portfolio to invest in. The perceived downside to the Sharpe ratio is that it uses total risk measured by sigma P, which includes systematic risk, i.e. the macroeconomic risk, as well as idiosyncratic risk, that is risk specific to the firms whose equity stocks make up that portfolio. And to overcome that shortcoming, we look at Traynor ratio. Traynor ratio overcomes that shortcoming identified in the Sharpe ratio by using the beta of the portfolio instead of the standard deviation sigma of the portfolio. Remember, beta values embeds the fact that all firm specific risks of the stocks that make up that equity portfolio have been diversified away, and therefore only the undiversifiable risk, which is the systematic risk, remains. Traynor ratio is represented as RP minus RF divided by beta P, where RP, as we saw before, represents the actual return on the portfolio, RF represents the return on the risk-free asset, and beta P represents the beta or the non-diversifiable risk in that portfolio. As in the case of Sharpe ratio, higher the Traynor ratio, better the risk adjusted performance of that portfolio. Let's go back to the same spreadsheet to see how train-or ratio can be used to further help us take a decision as to which of the portfolios we should invest in out of those 4 portfolios that we saw earlier. Now all I've done is added one more column here, which is the train-or ratio, and as we saw, the formula for train-or ratio is Rp minus Rf divided by beta P. In the Sharpe ratio we used sigma P, here we use the beta P, and Rf is in this column and the beta is in this column. So very simple arithmetic, and the train-or ratio for the 4 portfolios are 5.68, 9.2, 5.71 and 3.72. Now remember, it just reinforces decisions that we taken earlier. Portfolio 4 has a negative Jensen's alpha, it has the lowest Sharpe ratio and the lowest train-or ratio, so you don't want to put your money in portfolio 4. You can go to portfolio 2 because it gives you the highest Jensen's alpha, it gives you the highest Sharpe ratio, and it gives you the highest train-or ratio. The only catch is it's giving an extraordinary return, actual return of 17.38%. So you got to go and examine how sustainable is that high return in the years ahead. If you're convinced portfolio 2 is the right way to go. And the dilemma between portfolio 1 and portfolio 3, both had, if you recall, a Jensen's alpha of 1.13, but if you look at that Jensen's alpha in combination with the Sharpe ratio and the train-or ratio, portfolio 3 comes out a winner because it has a higher Sharpe ratio and a higher train-or ratio than portfolio 1, which is 0.35 and 5.68. And the reason for that is pretty straightforward. Sigma P is lower for portfolio 3 than portfolio 1. Beta P for portfolio 3 is less than beta P for portfolio 1. So with that combination, if I were to put my money into this, I would put 50% onto portfolio 2 and 50% onto portfolio 3. Hope that example helped you understand how the performance of equity stock portfolios such as mutual funds are evaluated on a comparative basis and on a risk adjusted basis on an ongoing basis by investors and participants in the equity stock markets.